Hello everyone, this is Sebastian McMahon from IA Financial Group, back with the weekly economic review for the week ending March 28, 2025. So as the title of the presentation says, the world is waiting for April 2nd, where we should have the next round of announcements on the tariffs from the Trump administration. At stakes, there's the deadline should be finished on the 25% tariffs on Canada and Mexico. Will we have some good news, a good surprise because negotiations are going on, or will we just go forward with blanket tariffs? We'll see. And the reciprocal tariffs will be announced next week. The reciprocal tariffs, no idea how Canada can come out of that. Of course, when you run the math and you say, right, the average tariff that Canada imposes on the US is 2%. The GST, which is a value-added tax, which has nothing to do with protectionism because of how it is built. It doesn't favor imported or domestic goods at all. But if it is included and it's part of the calculation, that's +5, so that's 7%. How will the Trump math work next week? We don't know, but this will be on top of the auto tariffs, because one thing that was clear in the communication this week on auto tariffs, that this will be on top of everything else. So there's a risk that we end the week with a much different situation than this week when it's all said and done next Friday. One number that is making the rounds also is that the reciprocal tariffs would be of 20% on Europe. This is a thing that's been making the rounds this week. And Brussels, so the European Union, is recommending to households in Europe to stock up on food and anything that they need, because they do expect some disruption. So what that means is that strong retaliation measures are likely coming next week. So it's going to be an interesting one for sure. In the 1930s, when a recession became the Great Depression, of course, it was a very different environment between two world wars. So parallels are always what they're worth. But this rise in protectionism then, and we didn't know then as much as now on the economic science, but the idea was to protect U.S. jobs, raise tariffs. Everyone started to do that to protect their own jobs as well. So global trade fell, prices rose for everyone, and a recession became the Great Depression. Not saying at all that we are looking at something like this, but we've known from the past that there could be sizable impacts from spirals like this. Now, where will we end up this time, and how will politicians react, and can the Trump administration also be sensitive to an economic downturn, to a market pullback? It's still up in the air, but just to make you understand that it's very serious. And as investors, the way that we look at it is that we need to understand clearly what kind of environment we're in, and depending on the macro environment, the market will behave very differently. So it's very important to use active management in these environments. For example, this week we had a very negative day throughout the week. The market was down, the most since at some point 2023. And this is for the month, but this week we had a strong pullback. Let's just use one day here. So on this day, it was mostly tech that was sold off. If you look at the equal weight index, you had a slight negative return, while the market was down close to 2% on that day. And if you look at the ratio of the number of advancing names versus declining names, you had more advancing than declining. So this is rotation at play, and this is when you want to have active management, because active management will protect you from those big movements that you would see if you were investing passively. And a good manager will be able to rotate the portfolio and shield it from the pockets of weakness and help to get the pockets of strength. And also, diversified funds or balanced funds here make a lot of sense, because having stocks and bonds and being tactical on asset allocation is very important, and I'll show you why in a few minutes. If you go from acceleration to stagflation, then you have some relationships that are flipping, and this is the job of an active asset allocator to position portfolios well to benefit from this, or at least protect the portfolio from it. So active management, balanced funds, Canadian stocks as well, because Canadian stock market is not the Canadian economy. You have energy in Canada, which is a very important part of the situation here. Could we see less tariffs on energy because it's so vital? Could we see export taxes on energy? So we could see a few things here. So it's easy to build a scenario where the price of energy goes up. You can also build some scenarios where the price of energy goes down. But Canadian stock market is in a very interesting juncture with valuations that are relatively low versus the US, versus history. So active management is pretty important here. So looking at the market this week, we've seen a bit of everything, mostly wait and see time. So price of oil was up 2.4%. Stocks were down, equities were slightly up, but this is all while the world is waiting next week. So no massive movements here on the week overall. If you when the week is said and done. So an update on tariffs. Trump announced 25% tariffs on all cars not made in the U.S. Now this part is kind of clear, but when you go to the details, well, for cars that are built in North America, and on average, when a car is completely built here, Canada, Mexico, or US, it has across a border between 5 and 10 times, because we make a part, we send it on the other side, it's assembled, and then the assembled product comes back in, more work is done, shipped back the other side. So it's, in the end, it's kind of a value added tax on the content that is not US. So how does that get calculated in the price? So trying to read everything we can this week, but I have yet to see anything else than panic and incomprehension by car makers and industry specialists. So it's not obvious what kind of price impact this will have. We're hearing $3,000 to $4,000 per car in the U.S. If you have an electric SUV, so the priciest part of the market, it's plus 15,000-17,000, the numbers that I've seen floated left and right. So it's sizable. So this is inflationary, and if you have inflation from a sector as vital as cars, and it's about 7.5% of CPI cars, you can think that the used car prices will go up as well. Based on this, you could think that maybe some US producers, which have nothing to do with this tariff situation, see an opening to raise their prices as well. So this could be inflationary. Less money in people's pockets, less consumption spending. That's 70% of the US GDP. So a slower economy because of inflation. So this is the definition of stagflation. So this is important. The share prices of US automakers were all down on the week, so they don't see the situation as a positive as well. Now turning to Canada, it's 144,000 jobs in Canada. In an industry that has very slim profit margins. So of course the hit will be should be massive. It always depends on how long it lasts, but still the workforce is concentrated in a few places, mostly in Ontario, Brampton, Oshawa. So of course this will have some impacts. Now politicians were reading left and right that maybe it's the time to open our markets to Chinese cars. So all of these things will be decided or discussed by our politicians. So I have absolutely no insights here, but those are very deep issues for Canada's labor market, and of course the regional market, especially in Ontario. So TBD, but next week is going to be even more, let's say, eventful than this one, if you can believe it. U.S. consumer confidence falling again. We've presented that chart a few times in the past. There's two major surveys of confidence in the U.S. The University of Michigan one, which we discussed, I think, last week or 2 weeks back, the gray line at the bottom. So consumer confidence is down big. This one has more to do with personal finances. The other one is the Conference Board, which is the blue line. It's more impacted by the views on the labor market, which is still doing well, although there are some cracks that are appearing. But this week, the trend was down. The confidence pulled back by more than what was expected. So we're seeing these effects. So it's nothing major yet, but it's pretty much a trend that has been set that the U.S. economic activity is slowing down, confidence is going down, and inflationary pressures are picking up. So this is a very slippery slope. So that brings us to this chart here. So as I was saying in the beginning, depending on what kind of macro environment we're in, markets tend to behave quite differently. Here we crunch data since 1955, so we look at growth and we look at inflation, and you have 4 quadrants here. So starting top right, you have an acceleration environment where growth and inflation are rising. Top left, you have stagflation, where inflation is rising, but growth is actually slowing down. Bottom left, you have contraction, where both growth and inflation are contracting. And on the bottom right, we have what we call Goldilocks, which is when growth is accelerating, but inflation is falling down. And as you can see, maybe you can pause the video here, or you can get the PDF on my LinkedIn account. But based on where we stand here, stocks, bonds, commodities tend to behave quite differently. And right now, the latest data that we have from February suggested that we were in the acceleration quadrant on the top right. So this is good for stocks, this is not so good for bonds, and this is good for commodities. But everything that we're seeing here, so it's always about where the puck is going rather than where the puck is. Everything is pointing towards going to the left, top left quadrant of stagflation, where the S&P 500 tends on average to be down 0.6% on a monthly basis. Government bonds are, long-term bonds tend to be positive, and commodities continue to do well, mostly gold. Now, what's priced into the market right now? When we look at it, when we discuss it, we have a feeling that the pullback in the S&P 500 that we've seen recently has more to do with the end of the US exceptionalism investment theme, not so much about the risk of stagflation, although there might be some sniffs of it into it. When you look at the behavior of bonds on a day-to-day basis, you can see that stagflation is starting to make its way there. But is stagflation priced into the bond market? Likely not. Maybe gold has sniffed it a bit more. Maybe the price of gold is more vulnerable here, but still, as we are moving over there, this changes our views, and this is where, again, active management and active tactical asset allocation has a very important role to play. So this is how we look at things. These are reasons why you should trust professionals and you should have balanced funds that are tacticals. But also we'll keep you posted, of course, on how things evolve in the next few weeks and months. But understanding this will be very important in 2025 and beyond. So what we'll be watching next week, of course, is going to be the April 2 announcement, but on the macro side, we'll have the job report in Canada and in the US. In the US, we'll have the JOLT survey, so the openings data, and there should be fewer job openings. On the manufacturing side, there should be a loss of velocity. On the services side, which is still doing well, we should have a stagnation. And on the jobs report, you should have less job created. So again, this is pretty much broad-based now that the economy is slowing down, inflationary pressures are rising, and it has a very important implication for investments. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content, please share. And of course, come back again next week to discuss what is shaping up to be another dowsy. So, all right, have a good one and see you next week.